Hello, everyone. Welcome into Above My Pay Grade. My name is Eric. Thanks for tuning in to my weekly Monday show. As I've said before, if you're a longtime subscriber, I'm going to try to limit it to once a week. I'm putting a little bit more thought into my show. And instead of reacting to the news, I'm going to kind of pull on a thread of a financial topic. And today's topic is why the government wants inflation. Now, you may not hear this come from their voice. You may hear them say, inflation's bad for the common man. We need to lower this. You hear Jerome Powell say this. You hear politicians say this in general. The reality is, not only do they want it, but they need it. They need it. And I'm going to go through these slides here and kind of describe as to why they need it. And then you can make up your own decision. I'm going to kind of at the end kind of tell you what I do in response to this. But the currents of inflation, meaning the tailwind of inflation, meaning we need it, is going to continue. And my prediction over the next decade or so is we're going to have continual inflation. Government's going to underestimate it. You're going to have the only way you'll know is you'll have a lower standard of living. Things will become more expensive. You'll notice it in your milk and your gasoline, etc. But ultimately, at the end of the day, you have to deal with the facts presented to you. And the facts presented to you by politicians are going to be different than the ones in reality, unfortunately. And most people are going to be caught up in this inflationary vortex because the government needs them to be. And I'll go through that here in a second. So why the government wants inflation. Number one, you'll see this chart. This is one of the most important charts. Gross domestic product, which for you, gross domestic product in your own life is your salary. So gross domestic product for the United States is our salary. That's what we base our taxes off of. It's our gross domestic product, or GDP, some people call it. So you'll notice the red line, which is all sector securities and debts and liabilities. Notice the red line going parabolic up and to the right compared to our GDP. That would be similar to you taking on credit card debt at a much higher rate of increase compared to your salary. Now, your average person can see this, doesn't take a PhD in economics to realize this chart is unsustainable. So something's got to give. Something's got to give. So how are this is a kind of a pressure cooker is the best way I understand this. So when pressure is building up in the system, meaning more debt than it's growing faster than GDP, what is the release valve, right? Spending has to stop. Taxes have to go up. There's a lot of release valves that have to happen. So what has this caused? That chart, a lot of people, including millennials in my generation, have said, hey, life is more expensive. Life is different than in our parents' generation. One of the worst things that we've seen is the cost of college in 1971 and 1972. These are all inflation adjusted. It's $10,000 for a public 4-year college, and it was about $20,700 for a private nonprofit 4-year college. And you see the numbers. That has gone up exponentially. Private nonprofit 4-year college in 2022 is $56,100 on average. These are all inflation adjusted. Now, what does that mean? For the average American, for one single person, that just means they start off life with more debt. But this is why macro is so important. If you're starting off life with more debt, what changes do you have to make? Maybe you delay buying a house. Maybe you delay having children. Maybe you delay career choices. Maybe you delay moves. There's a lot of downstream effects on debt in a society. It helps the government. More debt helps the government because that means more taxes. But the average person is saddled with more and more debt on all things that we need. I would say education is not something we need necessarily. I mean, formal education. Education is free online, but the formal education of college, I don't think we necessarily need. Another thing we need, medical expenses, out-of-pocket costs. 1972 were inflation adjusted $915, and today they're $1,350. Vacations. This is kind of a fixed cost. In Disney World in 1972 was $1,170 for a 3-day, 4-night stay at Disney World for 2 adults and 2 kids. And in 2022, $2,600 $70 for the same 4-night stay. Now, a lot of people say, well, maybe it's gotten better, and we can argue about that. But everything we need, and vacation is not one of them, but everything we need has gone up. And I always ask people this question. Capitalism, the goal in capitalism and how you compete is to give a better product at a cheaper price. And if we live in a capitalist society, because you hear a lot of things like, we are in late stage capitalism. You hear it on social media all the time. We're in late stage capitalism. If we're in a capitalist society, then why is everything we need getting more expensive? If the goal in capitalism, in the area of competition, is to give you better products for cheaper, how come everything we need is getting more expensive? It's kind of a rhetorical question, but a good one to ask. The cost of a new car. Why doesn't this show up in the inflation indexing? Because they do something called hedonic indexing, which you can Google on your own. But suffice it to say, the government says cars are cheaper than they were in 1972. But inflation adjusted, you can see a new car cost $48,200 in 2022 versus $26,100 in 1972. So wages aren't increasing at this level, but everything we need is increasing at this level. What does that mean? Quality of life going down. You've heard stories from your parents, the baby boomer generation. They used to be able to graduate high school, one person work, support a family. That's not the case anymore. So like I said, this has downstream effects on society. Cost of a new home. This is the biggest one. Okay. 1972, inflation adjusted, average price $189,500. And in 2022, a whopping $440,000. So why is the government causing this? They want inflation because they have $32 trillion in debt. $32 trillion in debt, which means they've spent more than they've taken in. So they have a couple options, and this is why they want inflation. Option 3 is inflation. Spoiler alert. But they have a couple options to actually lower the burden on society, the debt burden on society. Option 1 is to raise taxes. So we spend more than we take in. What does that mean? We need to raise taxes in order to balance the budget. Here's the problem. If we were, I've said this many times on my channel, if on your W-2 it said Afghanistan war and it debited your account on your W-2 when you sent in your taxes, how long do you think that war would have lasted? Probably not that long, because people would want accountability. And so they don't want the numbers to be in front of your face. Inflation's hard to contemplate in your head, and it's this boiling frog syndrome, right? So they don't want to raise your taxes, but then it's in your face. You're seeing how much you're spending because of inflation, or because of how much the government's spending. Your taxes go up commensurate with government spending. And people don't like that. And they might hold the government accountable if it was actually debited from their W-2. But in reality, if we were to raise taxes, it actually cuts GDP, meaning taxes are a measurement, or they're usually 18 to 20% of gross domestic product, total economic activity in the economy. 18 to 20%, that's what taxes are. So if GDP goes down, guess what? Taxes go down as well. Because there's a certain point, law of diminishing returns, I'll show you that here, but it defeats the purpose of raising more money. Because if you're lowering GDP by raising taxes, your taxes are actually going down. Even though the percentage of what people are earning is more of it's going to the government, they're earning less. See the problem? So the government, this is really politically unpopular, and besides, it defeats the purpose. Because most people think, like I said, number 4 there, government will misallocate resources. So even if they're taking in more, they're going to misallocate it. They're not going to spend it. They're not going to spend down debt. They're just going to increase spending. How do I know this? Well, like I said, the law of diminishing returns, and you guys can look more into this, is Laffer curve, right? If you were taxed at 99% of your income after a certain amount, what would be your desire to earn that income? Probably very little. Probably very little. So there's a point at which government becomes so onerous on taxes that people's productivity actually goes down, because they realize that they're spending so much money giving it to so much time giving it to the government, that raising taxes actually has a negative effect on how much money the government's actually taking in. Like I said, they can raise the percentage of what you make and say, you have to pay 99% of what you earn to the government. What that causes is most people to earn less. So the government actually makes less money. So option number 2, cut spending. And I laugh, and you should laugh too, because the government's never cut spending. Because when they cut spending in one area, hey, maybe we shouldn't spend so much on the military. Yahoo! Okay, we spend more in another area. Total spending has to go down. So like I said, they have to raise taxes by 35% in perpetuity to pay for the promises they made, or they have to cut spending. This relies on the fiscal responsibility of Washington and the bureaucracy there, that even if they cut spending, they would allocate it correctly, which, history has shown and human nature shows they won't do that. Taxes must remain at the current level. So not only do they need to cut spending to balance the budget, they need to keep taxes at the current level. So they'll say, hey, we're going to cut Social Security, Medicare, and Medicaid, but you still have to pay for the same amount you're paying in right now. How well do you think that would go over with the electorate? Not well, in my opinion. So you can see, thinking like a politician, option 1 doesn't seem so good. Option 2 of cutting spending but keeping taxes high and telling that to the electorate, they're probably not into that. Okay. They have to cut benefits of Social Security and Medicare, which are inflation indexed. So as inflation goes up, so do these big ticket items, and military spending. So here's why I say, like, even if more revenues, meaning they tax people more, and assuming that would make more revenue, which it won't. Go back to the Laffer curve. You tax people more, it doesn't mean you take in more in taxes, because GDP is going down as tax rates are going up. So you can see that government revenues over the last 30 years have gone up and to the right. Look what else has gone up and to the right. Government spending. So no matter what we take in revenue, we take in record amounts of revenue. Guess what goes up by exponential, as an exponential function? The spending, unfortunately. So even if we tried this taxation thing, hey, we need to raise taxes by 35% on everybody. They're just going to spend more. They're just going to spend more. How do we know that they'll actually pay down the deficit and debt with that money? We don't. Every time they've gotten a windfall of money, like they did in 2020 and 2021 with capital gains taxes, they spent it. They spent it. And that's what people do when it's not their money. That's just the fact of the matter. So the question is the cutting portion. So if let's say we want to cut, okay, we want to cut, like I said, if we raise taxes, that actually doesn't actually raise more in revenue. But let's say we need to cut spending. It's what we spend money on that really matters. We did cut spending after World War II, but guess what ended? World War II. So there was a lot of spending. We were in a big deficit then. What's the deficit on today? It's on these long-term promises like Social Security, Medicare, and Medicaid. That's the lion's share of the budget. Of course, we can cut in other places, but you see healthcare, social services, and Social Security take up the vast majority of our budget. So how do we cut those and keep it palatable for the American people? Unfortunately, the reality is, and I've said this before, and it's very unpopular, you trusted the government just like people trusted Bernie Madoff, right? They trusted Bernie Madoff that he wasn't running a Ponzi scheme. And unfortunately, he was. And the people who were caught up in said Ponzi schemes are like, sorry, you lost your money. And when people trust the government and the government makes false promises and they have bottomless pockets because they can't default because they have a printer, and they trust that the government's not going to spend the Social Security piggy bank, and they trust that the government's investing it for them, they lied to you. They lied to you. That's just a fact of the matter. And it is high time, as I've said on this channel, we have to reform Social Security, Medicare, and Medicaid. A lot of people don't want it. And if we don't reform, it will either be reformed for you or you can reform it. One of those two things is going to happen. because denying its existence and pretending that we don't need to reform these programs just means that they're not going to exist in the future, whether you like it or not. So we spend too much, we overspend. We can't really increase taxes, in my opinion, and balance the budget. We can't cut spending because it's politically unpalatable. And think about the downstream effects of cutting spending. Grandparents now have to live with their grandkids or kids, and it affects society more than we can even comprehend. Cutting spending would. So option 3, which is the most likely, which is what I think people should prepare for, is inflating the debt away, meaning taking your labor and purchasing power away from you slowly. That's what they've been doing for years. Maybe you haven't noticed it, but that's what they've been doing for years. And you've started to notice it because government advertised inflation is higher, but that's going to have to continue at double-digit rates, in my opinion. Why is this the most politically palatable? Because it's kind of that boiling frog syndrome. If overnight they say, we're raising taxes by 35% to pay for Social Security, Medicare, and Medicaid, how well do you think that would go over politically? Or if overnight they said, we're cutting spending by 40%, how well do you think that would go over politically? Not well. So why don't they just not ask and inflate it? Inflate it away. Print the money. Print the difference with Social Security, Medicare, and Medicaid. That's what they will do. So, and by printing, I mean selling government treasuries, which we'll get into here in a second. It's the boiling frog syndrome. You guys have dealt with it your whole life. Life gets more expensive every year, and unfortunately, your salary doesn't keep up with it. And if you have these spikes in inflation like we have in the last 2 years, you really feel it. You really feel it. Easier to blame on greedy capitalists. You hear this all the time from Washington. These people are raising the prices. Sure, I give them that. Life, capitalists are greedy. Politicians are greedy. People are greedy. People are greedy. Now, were they greedy in 2017? Were they greedy in 2018? Were they greedy in 2010? Or did they magically become greedy in 2021, 2022, and 2023? Was that a magic potion where all of a sudden these capitalist companies became greedy? No. So what changed? Well, the government bazookaed money into the system. It's a cop-out, and it's not really intelligent, in my opinion, to say, hey, these greedy capitalists are raising prices in 2023. That's why you can't afford your groceries. Because it negates, like, hey, they were the same capitalists 10 years ago. What happened back then? What changed? You should always ask that question. It's easier for politicians to diffuse responsibility with the inflate away, because it is not like this decision in time. It is this boiling frog syndrome where they're slowly taking purchasing power away from you in order to pay off their deficit. So what are the consequences of inflation? Which I think they're going to do. They're going to inflate away the debt. As you know, right now, Jerome Powell is raising interest rates. But at the end of the day, the one number that you should keep in mind is government can't afford real interest rates. What do I mean by that? If inflation is here, let's say inflation is 9%. Government advertised, by the way, which you should always double what the government advertises. But government advertised inflation in 2021 was about 9%. In 2022, rather, 9%. So a real rate of return would be 10. What is 10% of 32 trillion? It's 3.2 trillion. How much do we take in taxes? On a good year, 4.5. You see the problem? If we're spending $3.2 trillion a year on interest only, just on our debt, we got a real problem on our hands if we have a real rate of return. So what they're going to do, in my opinion, is negative real yield, negative real rates, also known as yield curve control. They do this in Japan. Basically, the central bank, since no one in the free market wants to buy government bonds or government treasuries unless they give you a real yield, like I just said, 10%. If inflation is 9, I want 10. I'm not going to give you my money for a negative real yield. Why would I do that? So if no one in the free market wants to do that, what little bank sovereign bank do they have that could buy up their treasury for them? Well, that would be the Federal Reserve. So what will the Federal Reserve do? The Federal Reserve will buy up all government bonds and put them on their balance sheet, just like they're doing in Japan. Because the free market, the government can't afford real yields, and in order to keep the yields down, they have the Federal Reserve or the Bank of Japan print up a bunch of dollars and buy it. So it's literally going out one door and bought in another door. It is as stupid as it sounds, unfortunately. And in reality, a lot of these macro things are so simple, but when you hear it, you're like, that can't be true. That can't be true that that's actually what happens. And unfortunately, that is what happens. And that's what's going to happen with the yield curve control. So if you look at this chart here, U.S. 10-year treasuries compared to U.S. core PCE and core CPI, meaning inflation. Notice, after 2020, it's not keeping up with inflation. Again, government advertised. Now, the question you should ask yourself is, will inflation continue? Will more dollars be injected into the system with $32 trillion in debt? I think the answer is yes. So as more dollars get injected into the system, how can the government pay a real interest rate on those? The answer is they cannot. They cannot afford that. And if they try to afford it, that requires even more printing. Debt doom loop. So you notice this interest rate here is below CPI, and people think CPI might come down, and they also think that the Fed will eventually have to lower interest rates to zero, which means the bonds they're buying today will go up in price. But everyone's betting that Jerome Powell can't continue this raising of interest rates for no other reason. There's a lot of reasons, but the biggest one being sovereign debt. Governments around the world have a ton of it, and they cannot afford a real interest rate above the rate of inflation. So the CBO, which is the Congressional Budget Office, it's not just me saying this. They're saying net interest costs will account for 40% of federal revenues by 2053. And by the way, the CBO is very conservative. So net interest, meaning government's taking on more debt, which means they have to pay a higher interest rate. More and more of our tax revenues are just going to pay the interest only on our debt. Interest only. And that is growing at exponential rates. Why is it growing at exponential rates? Not just the debt, but the interest on the debt. Is because we have inflation. People want a real rate of return. And so this trend, you got to ask yourself, with the CBO saying this, with the $32 trillion in debt, with what we spend the money on, can they really contain their spending? Or do they have to print ad infinitum forever? And what are the consequences of that? Inflating away your labor. So what are the consequences? We all saw this in 2020. Asset price inflation. This was in 2020, by the way. And by the way, this was the catalyst for me during 2020, is I noticed, you'll notice the S&P 500 in 2020 had a 16% rate of return as businesses were shut down and people were staying home. How in the world can that happen? You should really ask yourself that. The value of companies went up in the S&P 500 on average by 16%, over 16%, at a time when the economy was shut down. So is the value in the S&P 500 based off of money printing and Jerome Powell and what the Fed policy is, or is it based off fundamentals? Because fundamentals would tell you, hey, the economy's shut down, these people are going to lose money. But the Treasury and the Federal Reserve pumped liquidity into the market, gave everybody money and stimmy checks, and that's why those companies went up in value. And that doesn't mean they had more profit necessarily, because inflation came right after that. So asset prices are normally the first to react to money printing, whether that be home values, which I got a slide here, Case-Shiller index of homes, how much, and I told you at the beginning of the presentation, home prices adjusted for inflation have become more expensive. Why is that? People are looking at their home, and they've been conditioned to do this, as a piggy bank, not a place to live, but as a piggy bank, a speculative asset, and it's debt that you can collateralize for 30 years. So in a way, real estate can become a great hedge against inflation because you can collateralize $500,000 at, in 2021, a 3% interest rate. And if inflation's 9%, it's inflating away your debt. So debt holders actually win in that circumstance. And so they're incentivized never to sell this thing, only to rent it, never sell it. So again, this has downstream effects on the economy, right? You have all-time low interest rates, jack the prices of homes way up. And now you have really high interest rates on homes, and no one wants to sell. All the people, including myself, with an under 3% interest rate on their home, why would I want to sell? Because when I sell, I got to go buy out in this market. And in this market where I have to get 7% on a new home, I don't want to do that. See the problem? So even if you jack up interest rates like they have on homes, if the supply is still low, you're still going to have that price stay high. And I'll probably do a longer video on when I think this will change. But here's the problem. Asset prices, everything people need goes up in price, right? So you saw it in S&P 500. You saw it across all indexes. You saw it in homes. We all felt that. I don't think that's going to change until we have a deep recession. And what will cause people to sell their home is when they lose their job, unfortunately. But in an effort to help in 2020, printing money, giving out stimulus, you ask yourself, are you spending more money? Are you in a net better place today than you were in 2019? Economically speaking, most people would say worse off. Even if they didn't change jobs and all that, even with all the stimmy money, life is more expensive. With inflation, energy, all the things that cost money in life cost more. All thanks to the Federal Reserve and the Treasury. Obviously, we have commodity inflation. Everything you need in life, and this is, again, you should ask yourself this question: why is everything more expensive? Why are things we need, healthcare, homes, cars, why are they all more expensive? And a lot of people say, well, TVs are less expensive. Well, TVs, if we didn't live in an inflationary world, would actually be even cheaper than they are. Because sometimes there are deflationary forces that are stronger than inflation. But you see these items in blue here. They're cheaper, but they would be even cheaper if we didn't have government printing money. But there are things that don't have an elastic supply, like human labor and capital and energy. They don't have a huge elastic supply, meaning as demand goes up, that you cannot expand the supply big time. And so what's the release valve on those items? They go up in price. They go up in price. And you can see it here on this chart. Everything you need, from education to childcare to homes, they've all gone up in price compared to people's incomes. Question is, will this trend change? And I don't, unfortunately, think it will. And last slide, I'll talk about what I'm doing about it. But so as the supply of money breaks down, inflation means basically your individual $1 bill is being devalued. It buys you less. So you compare it to goods and services, it's going down versus goods and services. It might go up versus other currencies. Doesn't really matter here in America. But it is going down versus goods and services. What does that do? It breaks down relationships. It breaks down the supply chain. Think about if you were a supplier who is doing a 1-year contract with a vendor. How do you ever make solid economic calculations when your denominator, your dollar, the dollar is constantly fluctuating in value? It is very difficult to do, so it breaks down supply chains. It's very hard to make long-term contracts on things that aren't fixed, like the dollar. The dollar's value is not fixed. And it goes up and down based off goods and services. And the general trend, when I say up and down, if you zoom in, it can go up and down based off goods and services. Zoom out, it's going down to the right versus goods and services. And that will continue. Well, that's very hard to do. That's why people like real estate, because it's a fixed contract, for 30 years. And real estate probably going to go up in price compared to the interest rate that they have, especially if it's under 3%. So what to do about it? Out of all these videos, this is why I kind of decided to do weekly ones, because there's a whole bunch of doom scrolling I've been doing. It's bad right out there. Banks are collapsing. Politicians are dumb. We got a debt ceiling. We got all this stuff. But I like to do that zoom out and say, okay, it doesn't matter, as I've said many times, if Ron DeSantis becomes president, Trump becomes president again, all these things don't matter when it comes to that big old number of 32 trillion. They cannot get out of that problem, right? So we will, those one of three options, one of those three things is going to happen. Doesn't matter who's in office, doesn't matter who's in Congress, we have that debt burden. And it's been fairly bipartisan to have all that debt, right? So they still have to have a release valve for that debt, no matter who's president. And the question is, how will they do it? And how fast does it happen? I think, like I said, we're going to see double-digit inflation over this decade. You might see periods of deflation, meaning as Jerome Powell raises interest rates, banks are collapsing, people can't afford their homes, people are getting laid off. And then once that pain is palpable throughout the entire economy, Jerome Powell goes, okay, we're going to lower interest rates again, which is money printer go burr, in my opinion. So what to do about it? Number one, I say this to myself all the time: savings is behavior and investing is knowledge. A lot of people spend 95% of their time on that knowledge portion, like this get rich quick. Hey, maybe if I put $1 in this this coin here, and Doge or whatever, I'll become a millionaire. And that's really not reality. The thing to understand about money, which I preach to myself all the time, the currency that you save is just saving productivity for the future. And when you spend debt, that is spending productivity in today for the future, right? So when you save, you're saving productivity for the future. I advise not saving in dollars because they print those into infinitum. But when you save a currency unit or anything, when you save anything, that is saving productivity, or energy, for instance, is saving it for the future. So number one, you need free cash flow. So when I said saving is behavior, you have to have more money coming in than you have going out. I know that's, pretty novel idea. But a lot of people in America, we are a spendthrift country. 70% of our economy is consumption. So we're advertised by these advertisers to consume, run up debt, all this kind of stuff. So if you want to be different, if you want to be the person who does not do that, you can really capitalize in this time when we have a rush of deflation, like I think will happen, and then we have long-term inflation. And keep in mind, we can have inflation or stagflation, which is the worst of both worlds, which is inflation's going up and unemployment's going up at the same time. So people are losing their jobs. They can't afford anything, and it's going up in price. You can actually have that. That's called stagflation. So if you're a person who has free cash flow, you have more coming in than you have going out, you're saving productivity for the future. And how you spend that is up to you, but you have to have free cash flow. So if you don't have that, I focus on that first. Get a side job, get a side hustle, save more, cut spending. There's really only three levers: spending, investing, and income. First, easiest lever to pull is your spending. Figure out what you can cut in your spending budget. And if you're still squeezed at the end of the month after you've cut everything you can, go to income, and then you can invest. Try to get more income. All right, I belabored that enough. So when it comes to saving, one of the things I tell people is your money, the numerator, the denominator is infinity. That is the amount of dollars out there. We don't know how many dollars are out there. And the government's going to print, and banks are going to print ad infinitum. So if you are saving in the finite amount of dollars that you can save in, just keep in mind that denominator is constantly changing, meaning it's going up. So what does that mean? You, fixed amount, denominator constantly going up, the percentage of that denominator that you have is going down, which means your purchasing power is going down. So I recommend people, when they're saving money, of course, we live in a world where they use dollars, and I think it's important to have some dollars on hand, because you go to the convenience store and try to give them silver, it's probably not going to work. But when we're talking long-term savings, when we're talking setting yourself up for the future, you need to save in things that the government can't print. And everyone has their own choices. But I always try to tell people, the first thing to understand is the problem. A lot of people don't even know that there's a problem. They think that somebody's going to come in on a white horse and everything's going to be fine, and the government debt will just flitter away and we could just not pay it, or none of those things are true. There will be a release valve, and that release valve will be through inflation, is my opinion. So if that's the case, I want to own things that the government can't print more of, right? Where the denominator, if you will, is somewhat fixed. So own productive assets, things that produce goods and services, things that land that produces, or chickens that produce eggs, or land that produces food or water or what have you. Those are all productive assets. Invest in things that don't rely on the printer. Like I said, the S&P 500 went up and to the right, right? Were those companies more productive? Were they making more profit? Or was that front-running inflation? It was front-running inflation. So I'm not anti-stock market, but the stock market, in my opinion, is extremely, extremely overvalued right now. Doesn't mean it'll always be that way, but right now it's extremely overvalued, because all you need to pay attention to, if you don't think it's overvalued or not, all you need to pay attention to is when Jerome Powell speaks during the FOMC meeting, the stock market has wild swings. Why is that? Because it's not fundamentals. It's not how much are we providing more goods and services? Are we becoming more productive as a company? It's, are they going to turn the money printer on, or are they tightening lending? That's all it is. So our entire economy is based off of, is more free money coming in? Are we going to get loosening lending standards, or are we going to get tightened lending standards? And that's really what Jerome Powell's doing, and that's why the stock market reacts every single time he speaks. I'm a fan of gold as insurance. I'm a huge fan of Bitcoin. A lot of people aren't, but to those people that aren't a fan of Bitcoin, I say, do your research. If you've done research and I still think it's stupid, that's on you. Land, another productive asset. Real estate, store up goods like food stores, water stores, water filtration, etc. And then hedge jurisdictional risk. What do I mean by this? Let's say you're a landlord and you're in California. That's a bad place to be a landlord. Why is that? Because they're constantly changing their laws to become more friendly to tenants and less friendly to landlords, which means it's a very difficult state to do business. So where you plant your feet, the jurisdiction that you decide to live in, has a lot to do with, is it going to be a free market, or is it going to go down the tubes? I've said this many times. I think cities are going to collapse in on themselves, because as they raise taxes, as they keep giving out more and more stuff, you're seeing it right now, San Francisco, Chicago, etc. The productive people, the taxpayers leave, and the people keep asking for more and more stuff and vote for more and more stuff. Politicians acquiesce, and then there's nobody else to tax. All the taxpayers have left, and this will continue. That normally they're the first to leave. So jurisdictional risk is huge, in my opinion. If that jurisdiction can just take your property, they're not huge on private property rights. They're big on raising taxes, et cetera, et cetera. That's one of the largest risks you should hedge against, in my opinion. And lastly, buy local. I talked about the breakdown in supply chains, but the breakdown in supply chains, you don't necessarily have to worry about it so much if you buy your meat from a local cattle farmer. On top of that, you're benefiting the local economy. But if there's one huge conglomerate that sells all the meat to all the United States, that's because nobody wanted to buy local. If there's one huge conglomerate that does that, and there's an issue in the supply chain with them, then there's an issue with meat throughout the entire United States. You see the problem, right? So as much as you can, source what you eat locally, not only for health reasons, but in my opinion, It shores up the local economy, and it means you're less fragile. All right, guys. 40 minutes. That was pretty long. But let me know what you disagree with. I'm going to do another one of these next Monday and talk about other subjects you guys want me to cover a little bit more in depth. But I kind of wanted to conceptualize for people what options the government has. And you can be the judge on what you think they'll choose, whether that be raising taxes, lowering spending, or inflating. But I think history shows and human nature shows that they're going to pick inflation. This is my 2 cents. Let me know what you agreed with, disagreed with, what you want me to cover next week, and I'll see y'all in the next one. Peace.